Gold is continuing to go up, but as long as it's being paired against a currency that intrinsically is losing its buying power, gold has nowhere to go but up long term. Short term, noise. Anything can happen. We could see gold move from 4,100 back to 3,800. I would look at these moving averages as levels you need to see for critical support.
This is an all-time record high for silver. It's eclipsed the peak from 1980. Now, not adjusted for inflation, but just the nominal price is now higher than at any point. And in fact, gold year to date is up 56%. Silver's up more than that, but gold's up 56%. That is the biggest one-year gain since the 1970s. And we still have 2.5 months left.
Gold and silver continue to dominate global attention as both metals push into record-breaking territory, signaling what could be the most potent phase of the bull market in decades. Gold has climbed over 56% year to date, marking its strongest annual performance since the 1970s, while silver has surged past its 1980s peak in nominal terms. These are not just price movements, they're reflections of a larger truth. Currencies around the world are losing purchasing power. The dollar's steady decline is fueling a flight toward tangible value, and the metals market is beginning to reflect this shift. Short-term volatility may trigger brief corrections, but structurally, the setup remains overwhelmingly bullish. GaryWagner, veteran technical analyst and market commentator, emphasizes that the fundamentals remain intact. As long as gold holds key support levels near $3,800, the long-term trajectory stays higher. PeterSchiff echoes this broader view, warning that a weakening dollar, persistent inflation, and relentless central bank buying are tightening the supply of physical gold and silver. With central banks hoarding, not selling, the available pool of metal continues to shrink, setting the stage for a sustained upward move. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you and enjoy the video.
I think that demand is far exceeding physical stock, and it is throwing off the futures market because if we pull up volume has been enormous. Well, I've just put up volume, and you can see how this has spiked up tremendously.
Yeah, wow.
What I believe we could see is silver take out the former levels, which we've done. You can see that on this 2-week chart. But I believe that we could see $55 to $58 silver by the end of this year, first quarter of next year. The point you brought up is a really fascinating point, and that is when there is a discrepancy between spot and futures pricing that is not natural, traders are going to come in and arbitrage the differential and try to pick that off and tighten the spread. Well, as you can see, we went parabolic beginning on Tuesday, the 19th of August. I have two basic simple moving averages, a 20-day simple in blue and a green, which represents a 50-day. Typically, a market technician looks at the 50-day moving average as an indication of whether or not a stock or commodity is in a bullish, bearish, or neutral trend. To be in a bullish trend, pricing must be above the 50-day moving average. Now, if we look back, there was a period of time between, call it the end of August and maybe the end of May, when it was actually price was actually oscillating in and out of that level. But for the most part, the entire year has witnessed real bullish sentiment. And the way that we can see that, of course, is the fact that the longer term 50-day is underneath the shorter term 20-day. And especially when you look at current pricing, we're looking at the distance between the two moving averages. They were very tight back around the 20th of August. They were almost together. They did not cross. And when they cross, in other words, if the market goes up and then you get the blue line crossing over the green line, that's called a dead cross. If it crosses above, it's called a bullish cross. So it's in the proper alignment for a full bullish demeanor. and the fact that these moving averages, the price distance between them is widening, that tells you that it's getting even more bullish. And that's important. We can see that in terms of how quickly prices have moved up and how wide the differential between these moving averages are getting. And that really bodes a whole lot in terms of bullish market sentiment. It continues to be bullish, and market sentiment is getting stronger. Well, the one thing that you said that alarms me is typically when the public or speculative money comes in droves into the market, it tells you there's a potential top. And even a potential top, as far as I'm concerned, would be a necessary way to kind of reset. I would look for a shallow and quick retracement and then back to a bullish demeanor. But when you get too much speculative money in, the large institutional players tend to use that as a price point to pull profits. Can happen. If the fundamentals are so overwhelmingly bullish, then speculator money doesn't really change the dynamics. But I have seen times in the past, and I've been doing this since 1980, so a few years, in which when the speculative money was rich, let's say, it's kind of like a lake filled with really big trout. And that's when the fishermen come out and cast their line. In that way, you want to be careful when you see that happening, but you can't argue with fundamentals.
Yeah.
And if the dollar continues to lose value in relationship to other currencies, but more importantly, if it loses value in terms of buying power, inflation, the one safe haven asset that historically has been an island, a bastion of safety, has been gold. It's been that way for a long time, and I don't see that changing. Personally, I think that we are headed right now, short term, meaning by the end of the year, to 4,300. However, I have a caveat, and the caveat is that at any point, we could see the market correct. The correction doesn't mean that the rally is over. It simply means that there is profit taking going on in the market. The other thing that would do that, of course, is if the fundamentals change. And right now, that doesn't seem that likely. And so I would believe that gold will continue to move higher, but we could see it consolidate, form what I call a base. When we look at our chart, you can see it sort of back in the beginning of September. Gold goes to about 96.70, and then it stays in this tight range with these bottoms, which represent either the closing price or the opening price, and as high as 37.26, as low as 36.74, before it pops up again. Then you get a couple of days of consolidation. Then you get a higher price, consolidation, higher price. Not really consolidation, you have larger candles, and now we have that move back up. So because of that, I still think there is upside room. I am surprised personally that we've seen such a huge move without any sort of a correction. Well, the one thing you have to take into account with central bank accumulation of gold rather than dollars, hard currency, which was the case years ago, central banks tend to buy, accumulate, hold. They don't sell. So anytime you get a central bank accumulating more gold, that's going to stay in their reserve. They're not looking to liquidate it as much as use that as an instrument to provide value. In other words, the liquidity they need. And so it's important to note that when central banks are accumulating, they're going to hold on to it for a while. So that will diminish the supply. And of course, that will accelerate the upside move. So the fact in China, I believe, is one of the larger purchasers of gold, even though they produce a tremendous amount, they continue to buy from the open market. And that gold will stay in the central bank of China for a long time. It's not something, they're not speculating. They're not looking to accumulate and then sell. When they buy it, they keep it. And so that will tend to tighten the supply.
Yeah.
Supply and demand economics, when supply diminishes, price can only move one way, and that's higher. And so that would be a very, very positive factor for gold. The more central banks are accumulating, the tighter the supply will get and the higher gold will go. I mean, who would have imagined to see gold in the area that it has, where it broke 4,000? If we would have had this conversation, a year ago, I would have probably been witnessing my last invitation to have an interview on Kitco. But now these numbers they're there, they're legitimate. I think that we'll see when gold corrects, and it will, because who put it best? There was a Fed governor that once said, Ben Bernanke, in relation to interest rates, trees don't grow to the sky. They never have, they never will. Saying there's an absolute ceiling to how high interest rates can go. And in the same way, gold is continuing to go up, but as long as it's being paired against a currency that intrinsically is losing its buying power, gold has nowhere to go but up long term. Short term, noise. Anything can happen. We could see gold move from 4,100 back to 3,800. I would look at these moving averages as levels you need to see for critical support. So, for example, right now, if gold is remaining above 38.90, even if it comes down and you get a couple of down days, it hasn't caused any technical chart damage. We haven't seen that all year.
Gold and silver markets continue to show strong momentum, defying typical correlations with the US dollar. Historically, a stronger dollar has applied pressure on precious metals, but recent market behavior is breaking that pattern. Even as the dollar experiences modest strength, gold and silver prices are maintaining their bullish trajectory. This signals a deep underlying demand that extends beyond currency fluctuations. When a currency tied to faith, rather than substance, weakens against tangible assets, it clearly reflects investors seeking safety and value preservation amid systemic uncertainty. The data now shows gold up more than 56% year-to-date, its most significant annual rise since the 1970s, while silver has surpassed its 1980s nominal high, confirming the beginning of a much broader secular bull phase. Meanwhile, central banks around the world are actively de-dollarizing, reducing their exposure to U.S. treasuries and accumulating gold reserves instead. This behavior suggests a global shift away from reliance on the dollar's reserve status and toward hard assets. As the supply of physical metal tightens and the world's faith in paper currencies weakens, gold and silver are emerging not just as hedges, but as primary stores of value once again. The unfolding dollar devaluation and sovereign debt pressures are laying the groundwork for a significant revaluation of real money. Let's get back to the interview.
It's not the norm because there is an inverse relationship between the dollar and precious metals, because the precious metals are paired against the dollar. However, you can get scenarios where the dollar's moving lower and gold and silver are moving lower. Typically, any kind of dollar weakness is going to have an identical effect on gold and silver. Dollar weakness is going to turn it on its back, so to speak, and that's going to lend strength for the precious metals. An upside move in the dollar will simply give it strong headwinds that it needs to overcome to have an equal move. In other words, if the gold gains $20, in dollar neutrality, but in one case, the dollar has moved up 2%. Well, gold has got to move up 2% to just be neutral before it can show a gain. So you can see the dollar have strength and gold and silver move up. And when we look at this daily chart, you can see that the dollar moved from 96.69 up to 99.46. So it's moved more than a couple of percent, and yet gold and silver continue to move up, and in fact have moved up during the period of September here.
Yeah.
So it's just headwinds that the metals have to overcome just to break even. And when you see dollar strength on a day when gold was up, realize that gold first had to overcome the dollar strength to show any kind of positive tick. Well, it depends on how you're using the precious metals to add to your portfolio.
Yeah.
If you're talking about physical accumulation, you should have built a base already, and you're adding to that base at a more expensive price. So your dollar cost averaging to the upside, which isn't as favorable as dollar cost averaging to the downside. But of course, if gold is moving down and you continue to buy those dips, the inventory you had has less value. But an old teacher of mine used to say the price of gold or silver doesn't really matter if you're holding. It only matters at two periods: when you're buying and when you're liquidating. If you're holding, the value of a coin is still there. The value of a 10-ounce bar is still there. The value of a kilo is still there. And it's not a question of will it gain value in the future. Over time, typically, when paired against a fiat currency, it can only move higher because gold has intrinsic value, and the dollar is backed by what? The faith in our government. As long as it allows you to pay bills, to transact business, it is the mode of commerce. People aren't going to buy a house and trade, 6 camels and a horse. That doesn't happen. They're going to use dollars to do that. But gold is always going to have a intrinsic value. And as long as we're pairing it against a fiat currency, whether it's the dollar or the euro or other currencies, over time, the intrinsic value of gold, let's say that maintains at a level pace, but the currency itself is going to go down in terms of buying power. I'm not referring to the relationship of dollar strength or weakness against other currencies, which is what the index does, but the inflationary pressure. So what does it cost for a loaf of bread, a gallon of milk, a gallon of gasoline, things of that nature? And as long as fiat currencies are being used to transact business, over time, it takes more currency to purchase the same amount of a commodity. And that's not going to change because the currencies aren't backed by anything except faith in the government. They're not on the gold standard. That's long past, that train is run and past the station, so to speak.
Spot silver is at $52.20. It's actually, you're quoting December futures,
Correct.
which are normally above the spot market. They're actually below. I think we're setting ourselves up for a huge short covering rally. But this is an all-time record high for silver. It's eclipsed the peak from 1980. Now, not adjusted for inflation, but just the nominal price is now higher than at any point. And in fact, gold year to date is up 56%. Silver's up more than that, but gold's up 56%. That is the biggest one-year gain since the 1970s. And we still have 2.5 months left. But when gold started to move like this in the 1970s, it was the beginning of a huge move. Gold went from $35 an ounce when we began the decade to $850 when we ended it. So I think this is the beginning of a much bigger move in both gold and silver. And, first of all, what it tells you about the stock market, the U.S. stock market's really been in a bear market for 26 years, because in 1999, the Dow was worth 45 ounces of gold at its peak. It's now worth barely 11. So that's a 75% decline in the real value of U.S. stocks measured in real money. But I think what we're seeing now is a warning sign, similar to the warning that we got in 2006 when subprime blew up. That was warning about the financial crisis that hit the following year. I think what we may see next year is a U.S. dollar and sovereign debt crisis. The world is divesting of U.S. dollars. Central banks are unloading dollars in treasuries, and they're buying gold. And I think this means the U.S.'s ride on the global gravy train is coming to an end, because we base our whole standard of living on the dollar's reserve status. We use that to consume more than we produce and to borrow more than we save. And when the world doesn't want our dollars anymore, we're not going to get their goods. They're not going to loan us money by buying our bonds and our mortgage-backed securities. So Americans are going to be looking at much, much higher consumer prices, much higher interest rates. And this sovereign debt and currency crisis will make the 2008 financial crisis look like a Sunday school picnic. Well, first of all, you don't have to buy a whole ounce of gold. You can invest whatever you want. You can buy gold ETFs. You could buy fractions of an ounce. And silver, people can buy silver $52 an ounce. You can buy plenty of ounces of silver. We sell silver and gold at Schiff Gold. But I really like the mining stocks. Pan American Silver is probably the highest quality of the silver miners. It's not up as much year to date as like a Coeur d'Alene or a Hecla. But if you look at a longer term chart, Pan American didn't go down nearly as much as those stocks did. So it didn't have that lost ground to make up. But it's a great quality name if you're just going to buy one and you want less downside risk. Agnico Eagle also hasn't done as well as some of the lower quality miners in the last few months. But zoom out, it's been a phenomenal stock. AEM right now is $171 a share. I've owned it for 20 years. I bought my first shares below $10 a piece. So buying any gold stock or silver stock, I think the whole group is ridiculously cheap, and the earnings are exploding. There's no other sector of the market that has the earnings growth that gold and silver companies have. And Wall Street has completely missed the boat so far. They haven't been invested. In fact, a year and a half ago, they were putting sell signals out on the mining companies because when gold was at 2,000, they thought it was the top. They said that there's no upside in gold. Well, it's more than doubled since then, and Wall Street still hasn't really embraced these names. Now, I'm just starting to see, for the first time, I've been in the financial industry for 35 years. This is the first year that I've seen any firms, like Morgan Stanley came out and said maybe the 60-40 portfolio should be 60-20-20 with 20% gold.
Right. The financial landscape is shifting beneath our feet, and what we're witnessing now is the return of real money to the global stage. Gold and silver are no longer just safe haven assets. They've become a measure of trust in a system that's quietly losing credibility. When central banks, sovereign funds, and major institutions all pivot toward hard assets, it's not a coincidence. It's a signal. The market is beginning to reprice reality, where paper promises are fading and tangible wealth is being revalued. For decades, fiat currencies have carried the illusion of stability, supply constraints, rising premiums, and record central bank accumulation tell a clear story. Confidence is migrating away from government-backed debt and into assets that can't be printed. Gold's relentless ascent and silver's explosive performance are symptoms of a more profound structural realignment, one that few are prepared for. In every cycle, the public arrives late, chasing prices when the smart money has already positioned. But right now, those who understand this shift have a chance to get ahead of what could become a generational revaluation of precious metals. This isn't speculation, it's preservation. It's the quiet move from paper wealth to enduring value, from currency exposure to tangible sovereignty. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.